Good. And I'm not recording quite yet. I'll hit the record button, recast recorder. We're going to hit this for planning and scanning. PNS-12-1-2014. Do not hit the start button quite yet. Okay, so here's what we have. We now have 2015-02 up in the corner, stands for 02, stands for the second month of the year, which is February cattle. This is June cattle. This is the Feb versus June spread, which is a pretty wild mover in this spread, as you can see. How wild? Well, about 6 cents, and that's $2,400 on a spread. From August to the peak high in October, not many weeks, that spread was worth $3,000. And now the spread is coming back down, and we will re-examine, and this is really good news for folks that are looking for, as a great example. Maybe I should record this, and I'll get to that in a minute. I should actually record this, so let's do it. But anyway, I don't want to throw Arthur under the bus and have his name on a recorder that thousands of people will see when we email the planning and scanning to the folks that review this after the closes. So I wanted to give Arthur thanks, because I didn't realize that the spreads weren't updated and all of the pages. And so this weekend, as you can imagine, everything got updated. Spreads, grains, RS, every single page got updated. So I tweeted that out. If you did not get the tweet, then absolutely go and hit publish. We'll do it on the other computer when it finishes uploading and end of day updating and all of that other wonderful stuff. So I am excited and happy to be here for the month of December. The last month of the year. We got to make this one count. So welcome everybody. Bill McKee, great to see you here. Andy Wyan, of course, and Sonia, Ed L, and Don, and John, and Zaz, and Jim Lewis, and Harvey Schuler. Harvey, you got to get out of Manhattan, my brother. You got to get your butt down to Florida. You got to come back to Palm Beach. I mean, it's calling you. I can hear it. Harvey, Harvey, return. Any event. Ruth Watson, good to see you. And Mimi Tan. Mimi, it's because of Mimi that she suggests, John, you have to slow down. Slow down. So with that said, let me hit the record button, and then I'm going to slow down in honor of Mimi and Jimmy and Harvey and, of course, Gary and Frank and Ed L and Fook and Mr. Wong, Don and David and Bill and Craig and Clayton and Mitsu and Shri, Bruce, Robert. Hello, good morning, and to everyone out there, thank you for being here and joining us this morning. So we are recording. It is December 1st, and I wanted to say our Genesis trade page, every single page has been updated. And so with that said, we're going to start with the meats page, because we do have a little position on in live cattle in the February puts. Got in a little early, should have added on, coulda, woulda, shoulda. That's okay, but we will have a chance, and I think that this market in time has an opportunity to maybe get back down into the 164.65 in time. Should be the next week or so. The chart in front of you, if you note here, this at the very bottom is a spread chart. So the funny thing is sometimes as we teach, spreads can sometimes give us inherent market signals. You can also use a spread to trade. It's called not just a spread chart, a pairs chart, a relative strength chart. There's multiple terms for spread charts. Stock traders call it a pairs trade, selling Coke, buying Pepsi. Buying Pepsi, selling Monster beverage. I don't know if that would work out, but you can create a spread relationship between two pricing structures. Gold versus platinum, silver versus gold, notes versus bonds, related like products, but yet structured and priced differently, competing products. Looking at a stock or a sector to the benchmark index, such as consumer discretionary versus the S&P 500. Or we can look at a spread relationship like we have this year, such as corn wheat. Other spread relationships exist that we looked at besides the notes over bonds, called the knob spread, and other spread relationships that we looked at, such as recently in October, such as the Russell versus the Dow, and the Russell, the small cap stock growth index, versus the S&P 500 blue chip. Those are spread relationships. What spreads can sometimes do for us is give us, not only can you trade the spread, which if you think about it, you're in two like markets, but you're still in two different markets in two different positions. So when someone tells you that spread trading is safer than outright, they do not know what they are talking about from a logical and realistic standpoint. Now, I'm not meaning to throw an educator under the bus, but I'm here talking to you as my friend, and I'm here talking to you as an investor. Think logically. If I'm in two like markets in two different time frames, and if I'm buying the short term and I'm selling the longer term, and if there is a glut of product, in other words, an increase in supply in the near term, and I'm long the near term, and there's a glut with no demand, price is going to go down. But if there's a perception that there's so much glut right now that later down the road there's going to be a shortage, and that's the month I'm short, well then I'm long 1 month, the nearby it's called. I'm long the nearby, and price will plunge on me. I'm short the far out or more distant month, and that's the one they think there will be a shortage, and the price goes up. I'm in two different positions, and I'm losing on both positions. So on what planet would that be safer than an outright, or less riskier than an outright? See the logic behind that? So if anyone says that spread trading is less riskier than outright, run. They're not telling you the whole story, or they don't have the experience, or have never experienced in the world of commodities a supply imbalance trade. A supply imbalance trade. So it happens with commodities in the grains. It happens in the meats. It's not so much relevant in precious metals because, you know, you're mining and maybe there's a short-term demand and a longer-term not so much demand. So certain products, like for example, if the Federal Reserve immediately raised interest rates overnight, the long end of the yield curve, both notes and bonds would go down in price because yield would go up, but bonds are more sensitive to interest rate changes. Therefore, bonds would go down much faster. And so in a situation in a non-consumable commodity, you can see, and also in a commodity that has growing seasons, such as corn, breeding cycles, such as meats, these are things that we need to understand before getting into a spread. However, what spreads are also good for is to understand if the spread itself weakens. And in this case, weakens means the price goes from positive to less positive. What the spread reflects is that the first contract, which is, as you can see in the upper left corner of my screen in live cattle, for example, that the February contract, and anytime you're doing a spread, the first contract that symbol that you input, no matter what platform you're using, whether it's Thinkorswim, TradeStation, Fidelity, Genesis, eSignal, I don't care. No matter which spread you input, the first symbol is the one that you would be long, for example. And if you're long that symbol, and the next contract month is the one that you would be short, for example. Okay? In that case, if you're long the front month, then you want, if you're long the front month, then you want the spread to get more positive. You want the spread line to rise. Now, because it's the front month, if you understand this concept of what the spread pricing differential is, that the front month, if that price and there's an increase in supply and a decrease in demand, then the price structure of the front month compared to the back month, the spread relationship should start to go down. So when we look at an individual stock or an individual commodity month, like say just February, you will note that I want to share this chart with you first and foremost because sometimes spread relationships can give us a definitive indication that perhaps that the market or the front month or that the demand or supply imbalance is starting to change. And so therefore, if you think that a market is peaked out in price, you can look at a spread relationship between the two various months, a nearby versus a far out. So looking at February versus June cattle, we would note that this spread relationship actually peaked on October 2nd. And then again, it made a secondary high on October 22nd. Now let's take a look at that and look at the chart itself and say, gee, let's look at cattle. And as you can clearly see, the spread on October 2nd was right here, or the individual contract was, and on October 22nd is that day right there. So the funny thing is that cattle prices themselves, the individual contract, live cattle actually has gone up in price, but the spread itself has gone down since that time frame. And what that indicates is that we are starting to see a rollover effect in the sense that the front month is losing its bullish grip. And so that is a very strong indication that we're starting to see a turn in the market. And then, of course, as you can see, a delayed reaction has occurred a month later, and we start to see live cattle prices starting to roll, which is nice. So sometimes spread relationships can give us better indications on market prices and the structure of the prices of supply versus demand, more so than an individual market. So with that said, that's one reason why we look at spreads. Another reason we look at spreads, just like how you can trade them as a quick lesson, is you look for series of lower highs and then look for a series of consecutive lower lows, or simple, you can use trend line analysis and look for trend line breaks. And as you can see, on or about the 20th of November is when that spread broke down below this little wedge formation it was creating. It started to make lower highs, and then finally it made a lower low. So that was on or about the, as you can see clearly here, the 20th. And so on the 20th, it was that day right there. So if you're looking at prices going up, you might get more bullish at the highs, but if you look at the spread chart, you may get a better inclination of a market reversal to the downside. So anyway, I just wanted to go through a little mini lesson on spreads. I know this is cattle. Many of you will probably watch this and look at this and say, I have no interest in trading cattle. And that's fine, but at least the lesson that I've given you on how to use spread analysis, or what we call relative strength analysis, is very vital, and you can use that in any different underlying market that you trade. So with that said, I wanted to go through some of the meats because we currently have a put option on in live cattle, and we were looking for a seasonal decline in the market. The volume started to move lower. We were at important resistance levels, and so such as monthly pivot resistance. And so preparing for an eventual seasonal decline, we're starting to see that market. And so therefore, you know, if you can start to get like maybe a double out of this, I think it would behoove us. We have seasonal weakness going in for the next week to 10 days. So on or about the middle of December, on or about the 18th, I believe, we want to make sure that we are out of that trade, take a profit on that trade, because they are February options. And if you think about it, as you get into middle of December, we're going to lose a little bit of theta. And so even though there's going to be more than 60 days, I'm just taking this as a little trade. All right. Now, we had over the weekend or last week on thinning market conditions, multiple market movements, such as a commodity liquidation. Let me go through and upload our documents for our weekly observations. I think was pretty, put a little bit of extra work because I told you I would, because it's a new month, number one. And putting together all the pages that needed to be updated in Genesis was just absolutely necessary. And one of our students is one that said, hey, we've got to change this guy. And he was absolutely correct. And so we thank him for, as I went through and I looked at some of the pages on the Genesis in the grains and the spreads and everything else that we needed to update, it was very important to do so. So with that said, let's take a look at refreshing some of the pages, such as I had too many annotations and drawings, so to speak, on our AD lines. Advanced decline saw a huge move on a daily chart. Let me get this back into focus here. Volume dropped off significantly, so the AD lines still look fairly strong in the S&Ps. All right. Looking at the NASDAQ was the leadership of the market here. Looking at the Russell, we have actually a little bearish divergence formation. And one of the things that we wanted to make mention as well is we did form a low close doji on the S&P futures, but not the cash spiders. All right. We do have some inclinations of some very strong concerns in the market up here. And we've been saying that for quite some time. On Friday, on Wednesday, near the close, once the cash market closed, the futures went and just absolutely berated some stops and really, I think the word is robando in Spanish, robbed some people that may have had their stops up near the highs, because they pressed, if you looked at an intraday basis, on how the market traded. And that's what makes holiday trading very difficult for traders, because you put your stop where you think it's safe. The market's so thin it can be pushed around easily, stop you out, and then you're out of the game. And I'd rather not play the game and play it on more fair, equal level than on thinner market conditionings, be right and lose a lot of money. And if you're going to do that, then play options instead. And that way you won't have that futures kind of like immediate loss, and you got a little duration. If the market's going to be truly bearish, then prove it to me by showing me strength over a couple courses of a few days. But on thinning holiday markets, and to make a move up to that 75 handle after the in the final minutes of Wednesday was just uncalled for. But it happened. So in any event, let's start off with our weekly positive thought. And this is something I thought would be kind of nice since it is the holiday. We live our lives by employing principles. Some are positive and some are negative principles. Fear is a principle. Greed is a principle. But I think we need to choose the positive ones this holiday season and for every year and every day of the year. Gratitude, patience. Patience is a very, very powerful and needed necessity principle for traders. Patience. Generosity, love, dependability, like fixing the Genesis, being able to be depended upon, to be able to do planning and scanning on time. Dependability. Being courteous, kindness, and love. If practiced in our daily lives, it would be hard not to experience a sense of joy, serenity, and peace. Anyway, this was an original one that I put together. Put a little bit of thought into that one. But if you want to use that, copy, paste, and put that into your own holiday Christmas cards and send it to our friends that celebrate Hanukkah, then so it and use it. Market thoughts, I think we all can read this later. We saw actually the interesting observation was the NYSE was negative on the week. It lost over 0.5%. Trannies was up due to the plunge in crude oil, and it had more follow-through on overnight. But anyway, that certainly, as I personally made comments about Goldman Sachs' $75 target, I think everyone was kind of wrong on that market, because 64 and change is pretty much an interesting concept for a short order decline. But I would say that because of that, I would say the good news for consumers will most likely, it should be good, but I think this is where gas pumps quickly lose and file insurance claims as their ladders were probably stolen and they can't find them to move those signs down. So it may reflect another week or two before we see another decline in gas prices. And that does make sense. So, if I bought as a distributor or a retailer and I bought gasoline 2 weeks ago price and I still have inventory, if I lower my prices today based on the current spot market, I'm taking a loss. That doesn't mean that I'm going to pass that savings on until I get through that supply. So that's why we don't see changes on the board so quickly as well. But in any event, we are, one of our stock positions we're still in from several weeks ago is a quarter small position on Amazon, and we'll do see how that moves going forward. Here are my little concerns. The S&P futures formed a daily bearish LCD pattern at monthly pivot. The IWM formed bearish LCD PPS and a decline on its AD lines, as I just mentioned. The NYSE formed a daily bearish LCD pattern. The diamond, and then one of the things is we talked on 1016 to look at the EWG. It's actually gone up 6% since we first recommended it on 1117, and that's a tradable ETF. So in that same time period, comparatively speaking, relative strength-wise, which seems to be today's theme, Germany's stock market in that short period of time since the 17 has actually outperformed the S&P 500. So your capital, instead of buying S&P futures and looking for the market to continue to go up, the outperformance, and even though the S&Ps did go up, it only went up 1.5%, but you got more bang for your buck by being with EWG in that time period by about 4.5%. McClellan oscillator, that's another interesting concept. We're testing the zero line reading between both the daily, weekly time frames. And we need to watch that because we might get a sell trigger if we cross and close below the zero line. Now, year to date, crude oil is down 32% with the NASDAQ up 21% and the S&P's up almost 12%. So the difference between the NASDAQ outperforming the S&Ps is that if crude oil is down, a lot of the energy stocks are dragging the S&Ps down with it. That doesn't mean consumers are running to the malls and buying a lot of stuff either. Malls did not look to be, we did not go to the mall Thanksgiving night at 5 p.m. I did not go to the mall Saturday, but yes, we did. I take it was not Sunday, it was Saturday. We went in the afternoon and they're like, yeah, you missed all the deals. And I'm like, well, you still got some 10% off. What was the deal Friday if I got 15%? I'm like, I would have saved that extra 5%. Oh, but man, Thursday night was incredible. Did you sell a lot? No. Not really. That was what a couple clerks had told me. They said, it wasn't worth us being here. I quote, I'm exhausted and I'm not getting paid what I should, quote unquote. Anyway, so that was interesting concepts of the consumer spending habits. Now, I think Cyber Monday might be a little bit different, and I think it's going to be a consumer that's very selective. Remember, we haven't seen consumers buy homes yet. They've been renting apartments. Maybe they're saving their money to buy homes in the next year. Perhaps that could be people are getting more conscious of value as well. I think that's one area we need to pay close attention to. Perhaps consumers, the reason they're renting apartments is that they don't have the down for it, and perhaps consumers are becoming more savvy and saving their money to buy properties and buy their homes in the next year or so. So therefore, we might not see a lot of consumer spending as we think. But that's my own personal, and I've been talking about this since I was in Denver over the summer, and I shared with you, I said, you know what I see happening? And I said, you guys share with me in your own areas. But I saw in Fort Lauderdale, in Miami, here in West Palm, out in Denver, I just noticed there was more apartment buildings, not condominium, apartment buildings being put up. Townhouse communities, not really single-family home building. And many of you gave me feedback and said, yeah, that's right. We see a lot. And then, of course, we've seen it on the news, weeks and months later, that is actually fact. So if you rent an apartment, think of what happens. You don't run to Home Depot and put a lot of, marble in a bathroom you don't own. You don't put brand new leasehold improvements. You might change the drapes and buy towels and things of that nature. But in an apartment, you can't put a TV in every single room. You don't have a big apartment. So, electronic sales might not be that great. If you're in an apartment, it's because you can't get a house. Why can't you get a house? 2 reasons. Your credit stinks and you need more time to build credit. Or B, guess what? You don't have the down, and therefore you're saving money. So I think the logical aspect is that the answers could be right in front of us. It's just that the media and everyone's not giving us maybe what might happen down the road. And with that said, this could explain why this holiday season might see a decline in consumer purchases on all the stuff at the malls. Things that might do well, retail apparel, certain retail apparel stores. That would mean department stores might not fare well. And so traditionally, from a seasonal aspect, department stores, Macy's, Nordstrom's, Ross, Kohl's, they do not do well from December 1st, after Thanksgiving, into the holiday. So there could be some really great opportunities for credit call spread theta decay in this time frame. The fact that a lot of the XOP, the oil sector, has gotten so beat up. We all know that major pattern that we look at goes, the money-making pattern is trend consolidation. And I think at this point in time, what we need to look at is that if the trend in crude oil prices is so strong to the downside, and let me get this up for you. And already we're seeing a move off the lows. But if we go from a trend on a monthly basis and you think about this huge decline, then maybe we're going to form a little V bottom. But, quite frankly, we were back here in 2009 at that old low right there. And I think it's probably from my, the interesting aspect is that we really are well off the kind of like the momentum lows here. So in a short-term basis, I think that this could be a very strong potential for a credit put spread opportunity in some of the energy stocks, especially those that are in the XOP. So what you want to do today is start hunting for stocks in the XOP and look for December expiration for some credit put spreads, just to point some stuff up. And that is right here. So Friday's S&P 500, funny thing is we generated 4 PPS weekly buy signals and 47 weekly sell signals. So that is, 10 to 1 or actually 11 or 12 to 1 actually. And if you think about it, not all of them, 27 were in the energy complex. So that means 20 stocks versus 4 were giving sell signals in the S&P 500. Now, considering the XOP is down 24% year to date, I think that's what I was pointing out. Opportunities exist for credit put spreads for stocks in that sector. And again, we will tweet out some great opportunities. Last week we tweeted out the high close doji in Facebook and Twitter, and both of those would have made some cash for you. December spread opportunities. Now, we saw liquidation in the materials sector. Gold sold off, and it came back fairly strong off the lows. Copper sold off, which has come off the lows pretty sharply. But this is the time where we start looking, and here's a December spread trade since we got into spread opportunities this morning and talking about how to set some spread charts up. You look to buy March copper, sell June copper, and you enter on or about 12.6 and you exit by 4.8. That's a longer-term trade, and you'll catch the seasonal trend of copper prices, and that might be one of the better ways to trade copper. Then you have your hogs. That is a bear spread on hogs by buying the back month, selling the nearby, April, June. Cattle. You buy April cattle, you sell April feeder cattle sometime after the first of the week. So we're looking for feeder cattle to outperform the downside from live cattle. Gold, platinum. Platinum is 50 ounces. This is a rich man spread. It's very, very high risk, but can be rewarding. But just remember, platinum's contract is 50 ounces, gold is 100 ounces. So the ratio is you buy 2 April platinum, sell 1 Feb gold, enter on or about right before the holidays, Christmas, and you exit by 1/16. Small short-term trade. Every one of these trades have had a 15-year, 80% accuracy win probability since actually 1990 is the date. All right. So it has a high percentage of success, but there are years that the market loses, and you need to watch these spreads. As far as a grain trade, buy 2 contracts of corn versus selling 1 March soybean, enter on or about the last day before Christmas, the 24th, and you exit by February 9th. And that makes sense in this market condition, in this environment. Buy signals on high close doji. On a weekly basis, I had Facebook, weekly low close dojis. I had too many to go through, but here's some higher probability ones. Stock sectors at quarterly resistance, it's still the transports and the biotechs. And this week, we have a few earnings out. Like before the market, we had Sears. We've got tomorrow, Bob Evans, Ascena, Retail Group, Abercrombie and Fitch before the market on Guess Jeans, Vigo. Not a lot, as you can see here, as far as any big Smith & Wesson, I guess FinServ, American Eagle Outfitters, Big Lots, and that's about it as far as what we have going through. The big economic reports will be the Beige Book out on Wednesday, retail sales, consumer spending measures, looking at Cyber Monday sales numbers. That's always kind of important. And on Thursday, we've got the Bank of England, we've got the European Central Bank, and then Friday, of course, we've got the monthly unemployment report out. And then we have options expiration for December currencies, live cattle, December, and January cocoa. And don't forget, Saturday is a full moon. Sometimes you get full moon reversals, and I always like to put that type of data and information out. As Bill McKee, one of our top students, and also contributor here in the room, when yours truly has been hands full, Bill McKee. It's kind of funny that has always stated that this weekly observation is like a Greek family restaurant menu. There's something here for everyone. Day traders, stock traders, commodity traders. So fit through what you need. And I think that we're still seeing more sector rotation, to say an understatement here. But we do have a lot here going on in the market. And as far as timing elements, some trade opportunities going forward, I think when we get the cash market today, if it follows through to the downside, we will generate a sell signal, and therefore we'll probably get back to, I don't know if we're going to fall all the way back to, 200, but 220, 202 in the spiders is probably, somewhere up near those old highs, maybe right into here, somewhere where about 2 weeks ago I said the market couldn't go much higher because it was on light volume. So it all depends on whether we get continuity, confluence of sell signals across the majority of these markets. The cash markets, the diamonds had a doji formation. The Russell, certainly that bearish engulfing pattern. We could see a decline here, and then on that decline, when it stops declining and we turn and reverse to a buy signal, I would strongly recommend to then use your Russell versus anything. Long Russell, short Qs. Long Russell, short diamonds as a spread opportunity going into January. I think that would be a spread opportunity. It's tough to do that using options, but I think possibly a premium writing program would be the best strategy as far as a trade. In other words, if we're bullish selling puts in the Russell, and it's hard to get an exact calculation on how many options, how far should the strikes be, but we can kind of work through that. Maybe it'd be a lot of fun this month to look for if it is possible to get some type of an option strategy that can combine that idea. I think, and it's low risk, it might be very rewarding. One last topic I wanted to bring to your attention here, and it's over here on our relative strength. And I know we already, it's in your daily sheet, but I just wanted to show you this, you know, and it should populate. The Russell, by the way, has had like 4 weeks of kind of dojis, and that's kind of an interesting concept. Looking at the Russell on your pages here, as you can see on 11:30 yesterday morning, everything's been updated for you, all right? Today, which was really, this is your daily McClellan oscillator, we will actually go negative on the board. So while the McClellan oscillator, I mean, that has got to be one of the strongest divergence scenarios that I've seen, and it was bothering me for quite some time now. And also another little element here is the spread relationship between the widening between NASDAQ and, of course, the S&Ps. That is one of the largest percent differentials I've seen in an enormous amount of time, I think since 2007. And I think if I go to a monthly chart, it's almost since like over in here in 2007. So the widening effect, you know, over time, you know, you do see NASDAQ outperform S&Ps, but when you're in a widening effect like this on a week-to-week, day-to-day basis, it does spell a little bit of trouble for the marketplace. So in any event, this is a weekly chart. We also have divergence on the McClellan oscillator, and of course we'd have to wait till Friday to see if that thing's below the zero line, and that's why we look at the daily. The daily now will have a pattern. This is kind of important, folks. The daily has a pattern of lower highs and potentially right now lower lows. So if you're excited about buying a dip in the market, I would strongly recommend to wait until you get confirmed buy signals in the market based on this technical information that we use. I rely on this information because it has treated us enormously well, as best it can be expected in the trading environment that we've seen this year, in my own humble opinion and my own humble P&L statements. So with that said, I will continue to trust this information. The spread relationship between the Russell and the Dow. This gave us, this is all information that, as you can see, we were starting to see lower lows that were less significant. And so we had the inclination to be long. In fact, I even tweeted this out, and someone told me that I was, you know, that I wasn't looking at the right thing, and I don't know, someone on Twitter got in an argument with me. It was, and many of you commented on that. It was kind of funny because we were covering this in our room. And the funny thing, as in September, and all of a sudden, as the market started to plunge, and you could clearly see that the Russell was outperforming. And so since the 16th, we started to see kind of the reversal in that marketplace. Now, in the last few weeks, the Russell's been hanging back and the NASDAQ's outperformed, the Diamonds outperformed. But now, folks, I think it's time to get back into or start to look for a consecutive series of higher highs and higher lows, and then we should get I would assume, a move back into maybe this zone up here. I would say that would be maybe not the high, but the average of highs over time. And so to me, I think that is, you know, a well-worthy spread relationship. And in fact, if we just take a simple trend line analysis and draw a trend off the extreme peaks, I mean, in time, this spread could come back and find resistance at that horizontal black line and that detrend resistance black line up in there. So that's a lot of room for some profitability in the Russell during the next, say, 6 weeks that we see that seasonality in the marketplace. Anyway, I hope that this kind of helped give you insights on spread relationships, what trades are out there, and also what we're kind of looking like in the marketplace and what indicators we're using here to move forward. With that said, we'll now conclude our recording and get into some day trading setups for the trading room. Thank you all very much and welcome back after this. I hope you guys had a great Thanksgiving holiday.